this. So essentially, the agenda for today's call is, Volcker rule, investment banks, derivatives, and pricing quants. Let's see how it goes, and depending on how we pace it out, maybe we can move to the next topic, or we can just stop it here. So even before going to Volcker rule, right, I would want to shortly start with something called as Glass-Steagall legislation, and I don't want to go into details of it. So there is a lot to read about it, but I would touch upon only the important point, okay, which matter for us as, let's say, quants, is the fact that in 1933 this act, kind of prescribed separating commercial and investment banks. Okay, what it essentially means is, if there is a deposit accepting entity like a commercial bank, uh, it cannot legally, as a legal entity or as a business, cannot work with an investment bank. In other words, investment bank cannot go and take the deposits from the commercial bank and invest it maybe in stock market or so on and so forth. Okay, you can look at the time of this act, and it is very critical that this was passed just after the Great Depression, possibly highlighting the fact that there is a kind of conflict of interest. If investment banks have easy and direct access to deposit, they'll just take that money and invest it in stocks. And what happens when everything comes crashing down, right? Depositors won't be able to have the same faith in the commercial banks if the commercial banks are not able to return back the deposits as and when depositors ask for it. So this is essentially what happened in 1933, right? And again, skipping a lot of details and coming straight to something which concerns us. In 19 November 99, President Bill Clinton publicly declared this: the law is no longer appropriate. Okay, I'll not go into details as to why that happened and how that happened, but important point for us is that it no longer held. In other words, it was commercial slash investment banks were up for mergers. You can have the same legal entity doing both, and so on and so forth, right? Now coming back to Volcker rule, right? So what Volcker rule states is, the rule is often referred to as a ban on prop trading by the commercial banks, whereby deposits are used to trade on the bank's own accounts. Okay, although a number of exceptions to this ban were included in the Dodd-Frank rule or law. Okay, so to summarize this, what it essentially says is, it doesn't exactly, put the same restrictions as there were in Glass-Steagall, that you cannot even form one single company, okay, which has two different divisions of commercial banking and investment banking. They said you can form that, okay, but proprietary trading based on those funds, okay, which were received by the commercial bank, cannot be used by the investment banks to maybe take positions in stocks or derivatives or anywhere else. Okay, so this brings us to a very interesting question, right? So how do you think investment banks, uh, I mean, why do they even have? I mean, they could have chosen for a demerger, right? That we have different legal entities, and you continue your and I continue my business, okay? But still, we see that there are a lot of banks who exist as a commercial, who have a commercial banking arm plus the investment banking arm, right? Where investment banking arm, you know, is involved in derivatives market. So, how do you think, okay, this ban comes in force? If it comes in force, then how does an investment bank make money out of it? Okay, so this opens up Pandora's box, and this essentially drives uh, our thought process going forward, right? So, Volcker rule says, you can take the money from investment banks can take the money from commercial banks as single legal entity, okay, okay, but they cannot do any prop trading, that is use that money to invest or in risky assets. Okay, so anyone on the call, right, maybe if you have any thoughts, okay, then what do you do with that money? Okay, so I'd like to hear your thoughts. uh,
Hi. I'm just taking a guess. Maybe they might be lending the money as a no, as a debt to the other arm. There's a fixed
Okay,
loan
so for that matter, you're saying investment bank lends, but to whom?
to their other arm, to their the prop trading arm.
Okay, but again, it's the same thing, right? I mean, not the same. Like you don't have access to the zero interest rate, roughly, which are there
Hmm.
in current and savings account.
Right.
But still, you have access to deposit, right? What happens if you lose? What happens when investment bank loses it? Who loses the money? Depositors lose it. The commercial bank loses it. Who loses it?
Yeah, I mean this can be just a workaround to the Walker rule.
Yes. So yeah. So essentially, it puts price to the cost of funds, right? So what you're saying is investment bank could have simply raised capital from market as a prop trading firm. Instead of that, they simply borrowed from commercial bank, right?
Correct.
But still that exposes to the risk, right? What happens if it goes down? I mean, if you lose the capital,
Right.
for example, that money goes zero, at least the depositors are not going to get back their money. Okay, even if
Hmm.
they might be getting higher rate of interest, they're not going to get back the money, right? Which is why you would require such a regulation.
Right.
But that I like that line of thinking. Okay, that instead of having zero cost of interest, you're at least charging certain interest to them,
Correct.
and still starting out with the business.
Yeah.
Anybody else? Any thoughts? So essentially what happens is, uh, what happens is investment banks are kind of allowed to trade. Okay, so investment banks will go and trade. Okay, the thing which is not allowed is depositors losing out on that money is not allowed. Okay, so how do you take position in something and not lose money out of it? For example, how do you buy an option and not lose money out of it?
You also sell it
Exactly.
as
So
your bet, basically.
exactly. So you hedge it out perfectly. Okay. So this is how, or this is the premise of the business model of investment banks. Okay. Now tell me. Okay, if you want to buy an option, okay, do you, let us say we are talking only about India. So do you go to a big bank in India, or you go to exchange, right? If someone wants to buy option in India, what they'll do is they'll simply go to an exchange, right? They'll go to maybe NSE or whatever, right? So they'll just go to an exchange and buy that option. Okay, so what value add does an investment bank does by being able to provide the opportunity to invest in options? Why would someone go to an investment bank and not to an exchange?
Firstly, it can provide you structured products
Exactly.
if you want a
So
customized
that's
product. Yeah.
right. So the value add of an investment bank comes in because they provide, you know, exotic products. Okay, so they can provide you digital calls, barrier options, and so on and so forth. So they do provide you a lot of such things which otherwise are difficult to get or access, right? So so now two things in mind, right? First, the book has to be risk neutral, right? And second, you're selling exotic options. Okay, so how do you keep your book risk neutral while selling or hosting exotic options?
So basically what you are saying is you will at the same time buy an option as well as sell an option so that
Yeah, but what
uh,
you're doing is you're selling exotic, right? So you cannot go to an exchange and get another exotic, correct?
okay, what does exotic means?
For example, a digital option, okay, or a
Uh-huh.
barrier option. Okay, you have sold a barrier option or a
Okay.
digital option, and you don't want the same option to be on your books. Okay, so what do you do about it?
Can hedge over the counter.
Okay, and like, okay, like that is one of the choices. Okay, but in the day, okay, you have sold maybe 1 million options. Okay, you will not be able to find a perfect counterparty to it on the OTC side, right? or another bank ready to take up the risk, then what you do? You have some unhedged risk left on your book. Okay, so what do you do about it? The thing what you do about it is you replicate it, okay, and hedge it out via an exchange. Okay, so let me let me give you an example. Okay, for example, if you look at a digital option, right? So this is how a payoff of a digital option looks like, right? So you know it simply jumps at towards the expiry and so on and so forth, depending on call or put. Okay, what you do is this is what you do. Okay, so you will sell a digital option, okay, and then you'll buy a bull call spread on the exchange. Okay, now that bull call spread will approximately replicate your original option. Okay, plus for the fact that this is at any instant. Okay, as the markets change, as the underlying keeps moving, you have to keep moving your bull call spread, okay, to that strike wherever your digital option is. Okay, and to counter that risk. Okay, so this is largely the business model in and around which the investment banks work. Okay, so if you are so coming back to the point, right? So Volcker rule says you cannot have risk on your books. Again, I'm talking very superficially. There are exceptions to it and so on and so forth. But I'm talking about a general large scale business model. Okay. Volcker rule says investment banks cannot have risk on their books, but investment banks still are part of commercial banks and they can do what they're good at. So they do buy, derivatives, and they are ready to be counterparty to anybody who wants to take whatever position. So someone wants to go long, they're ready to go short. Someone wants to go short, they're ready to go long, and so on and so forth, right? But a pricing quant who sits within an investment bank has a different problem to tackle compared to a pricing quant who maybe sits in a hedge fund, right? uh, Before we go to that direction, right, more importantly, let us discuss how does an investment bank make money then, right? If you so basic finance, right? To 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 generate returns you need to have risk. Okay, and if you have neutralized your risk perfectly, right, then where is that you're generating returns from?
By fees and commissions from the customer.
Yeah, but yeah, I mean, like, how do you charge fees? On what basis, or how do you do that execution? I mean, in terms of execution. So the way you'd be doing it is, someone would come and ask you for quote of a digital option, right? Instead of quoting him the model price of a digital option, what you'll quote him is a bull call spread. Okay, and maybe a little more to account for liquidity and bid ask spreads and something like that. Okay,
Yeah.
so once you so that is what you'd be quoting to your client and not really digital call. Okay, so you'll have to keep in mind while quoting to the client what you should be accounting for. And every single exotic option, okay, has an equivalent analogous hedge. Okay, so depending on how you model that hedge. Okay, simply going back to this digital option hedge, right? Do you think this is a good hedge? Okay, let us look at this image. Okay, let us go back. Okay, do you think this is a good hedge? Anybody? Can there be a better hedge? So what essentially is happening is, if you look at this payoff diagram, right? So at strike 100, it jumps up for digital call, and from 100, it starts increasing for bull call spread. Okay, you can have the same steepness, but if you just shift it to the left, right? Maybe it starts from 98 and goes to 102, right? And then stays the same, right? So that is one way to model it. That will simply bifurcate. So this error gets split. So sometimes will be positive, sometimes will be negative, and on an average, your PNL will be more close to zero. Okay. The third way to do is to put it at 98 or 96, 96 and 100, right? Now I would still go with this if I have a certain view, okay, and I want to minimize the amount of rebalancing that I would have to do. Okay, so these are choices which I have. Okay,
Sorry to interrupt. I just have a small question.
yeah,
So, in any case, we'll be losing the premium, right? I mean, we are hedging it, but the premium will be lost, right? Let's say the strike prices is not hit, and we are not actually exercising the option.
yes.
So the premium is lost, right? So isn't that a part of you can say risk?
No. Okay, maybe you're kind of understanding it wrong in this sense that you have sold a digital option. Okay, so as a bank you receive that premium from that guy. Okay, so
Correct.
if it expires out of money, the
Uh,
guy to whom I sold that option, that guy also lost money to me, correct? So I
right.
get that money. Now, to at the beginning of the trade, to hedge this digital call option, okay, I had
Mm,
gone for that bull call spread. Okay,
mm,
that also expired out of money, right?
mm,
So I as a
mm.
bank lost premium there. The guy to whom I sold this digital option, he lost money to me, correct?
Right.
So that nets out to be zero, okay, and which sits within the definition of Volcker rule. Okay, I did trade, but net
Yeah.
it netted it out. Okay, if for example if it ends in the money, okay,
Uh,
then from
uh,
that bull call spread I'll make the money. Okay, but then client also makes money from me, so I pay back to the client the same amount which I received.
but then you are not making any money out of the market,
Exactly,
right?
exactly, exactly. Which is what my first question was, right? So how do I make money out of it?
Right.
Where so I'll be quoting slightly differently. Okay, so I'll not be quoting for a 98 102 spread. Maybe I'll quote for 96 104 spread, something like that. Okay,
Mm,
in that
mm.
bid ask spread is where I'll make money. So in other words, for that digital call, whatever premium, so that guy is selling that digital. So I'm selling digital call, right? So I'm getting the premium from digital call. Okay, I'll make sure that is slightly higher than whatever is in the bull call spread that I'm paying out.
Okay,
Okay.
so you're technically making money out of the, we can call it maybe a commission, or I don't know
Yes.
what to call it.
Yes. Yes. So this is commission, but
Yeah.
there are various kinds of commissions. Okay.
Okay.
This is an implied commission. Okay,
Mhm.
so it comes from whatever quotes I make. Okay, and all my quotes are proprietary, right? So what happens is if someone wants to compete with me, another investment bank wants to compete with me. Okay,
Right.
that guy will make a lower quote, but in doing that what will happen is he will have to have a very tighter bull call spread. Okay, what that because of that what happens is he needs to keep rebalance his portfolio far more frequently than me. Okay,
Mm.
so over a long term, that guy loses out money. Okay. And again, like you understand, no one wants to lose out money. Okay. So
Yeah.
if you have sold out thousands of such options, okay, and you're to maintain that hedge, okay, if you have to keep rebalancing your bull call spread very frequently, then you will lose a lot in your transaction costs, right? So
Eventually, over time, different investment banks will come out with similar kind of, or rather,
exactly.
same
Yes.
bull cost spread, right?
Yes. Yes. Yes.
Then what's the say competitive
No,
advantage
so
over
for
one?
no, for
Then,
that matter, like there are enough retail banks, okay, and all of them offer the same product of home loan. Okay.
all right.
So if one bank is there, why does go to someone go to another bank, right?
No, but they keep varying interest rates or something like that among
Yes,
themselves.
but then everybody should go to the least interest rate, right? Which is
Uh,
not what happens.
yeah,
Which is
yeah,
not what happens, right? If that were the case, then every other bank would be out of business. So
right.
for the same reasons, you have options. I mean, choices that there are. I mean, people go to banks, and then again for the same reason, why would you take home loan for different from different banks? Okay, in the market, everybody should be taking home loan from the lowest quoter. Okay, who quotes the lowest. Okay,
Right.
so that's so this is the background of it. Okay, so investment bank is buying and selling lot of such exotics. Okay, it could be a barrier option. So for a barrier option you might require a different strategy. For maybe other options you'd require other strategy. Now, for example, you have a certain model, okay, and there is a certain error in the model, okay. So whatever is your price of call option, digital call option, let us say you are mispricing it with the error of 0.01%, okay, and you're also pricing your bull call spread with similar plus or minus 0.01%, okay, and similarly for digital call, okay. As an investment bank quant, right, you would be or might be okay with it. You get my point? In the sense that because both of them net out each other, right? Sometimes the error would be there on this side, that side, and it will hedge out, okay. But if you're sitting in if you're sitting in hedge fund, okay, the hedge fund guy is simply only buying the digital call option, okay. So for him, that precision is more important, right, to be able to say, what was right and so on and so forth, right. The quant who sits within a hedge fund, what he's trying to do is he's not trying to hedge the way the investment bank is doing. What it is doing is it does some research, okay, and based on the research it has a view, okay. For example, going ahead, the interest rates are going to go up or going to go down or so on and so forth. Now based on that view, to execute it, it goes to, you know to investment banks and get structured products, okay, and so on and so forth, okay. Now let us say you're a hedge fund, right, and as a hedge fund you have two options. You can buy a long call option or you can buy a digital call option, right. uh, Both of them, you'd make money if it ends up in the money and so on and so forth, right. Why do you think s- a hedge fund might instead buy a digital call option instead uh, of a long European call option? If someone can, brainstorm it, why would someone buy a digital option when you're long on certain underlying instead of buying a long European call option? Okay. I mean, the reason is similar as to why would you buy an option instead of buying a future? If you can buy, if you can long a future, why would you buy an option?
Capital investment is less for more gain,
For
for more percentage gain, like more gain. I mean, by buying an option, it's
yeah,
you are
that is between futures and options, right?
yes,
But between digital option and an option,
yeah, that is yeah,
uh,
uh,
the answer still remains same. Okay, buying a digital option will be cheaper than a normal option. Okay, simply because you get payoffs in an option. Okay, for different conditions. Okay, max of s minus k comma 0 and all of that, right.
yes,
But here your digital, and so goes for other exotic. For example, Asian option, price of an Asian option will be lesser than an European option. Okay, price of barrier option, okay, so knock-in barrier plus knockout barrier, price of that will be equal to European option, okay. So only for a certain section of payoffs you want to make money out of it, right. That's when you would go for these exotics, okay.
so I can equally say that the risk will also be more for digital option than a
Yes,
European option.
yes, I mean there is a always a trade-off, right.
Yeah, yeah.
Otherwise, if something were uh, what do I say, objectively better, right, lower risk and better returns,
Everybody would have
obviously,
chosen that. Yeah,
yeah, that's right.
got it.
So that's so this is how a quant who sits within an investment bank would be thinking differently, about derivatives, about, anything about structured products, about hedges, you know, about bonds, and so on and so forth. Okay, and someone who sits within a hedge fund would be thinking about it altogether differently. Okay, and let me give one of the example, right. So for example, someone who's sitting in hedge fund, his job is to find some such thing, okay, which maybe does not sit in the current framework of the way things are supposed to work. Okay, for example, there is something called as low volatility anomaly. Okay, where like I said, as per CAPM model and all, which is, let us say, the existing framework, higher volatility or higher risk stocks are supposed to give you higher returns, right? But what was actually observed in data is if you have lower volatility stocks, they actually give you higher returns than high volatility stocks. So if as a hedge fund you identify such an anomaly, your objective would be to exploit it. Maybe go short on high vol stocks and go long on low vol stocks, and make money out of it. Okay. But whereas for investment banks, the objective would be different. The objective is how good you can hedge it, how correctly you can hedge it. Okay. So in terms of hedging, okay, there is a trade-off. Okay. So if you price it too correctly, okay, what will happen is you will have to rebalance your position too often. Okay. And it will increase your trading, it will increase your transaction costs. Okay. The other way around, if your pricing is not perfect, so what will happen is your expectation, your expected PNL, okay, will be non-zero. Okay, and sometimes it can be positive or sometimes it can be negative. You have to keep in mind that within investment bank there is no what I can say, nobody rewards you for having a net positive PNL. I mean, in the context of the fact that anyways you are supposed to keep the risk to zero, right? So having positive PNL also means that the guy could have also had negative PNL. His objective was to keep the expected PNL as close to as zero as possible while managing your transaction costs, while not letting your transaction cost run away out of your hand. So since your expected returns are zero, so you don't see in terms of returns. What you see is in terms of risk. I mean transaction costs. So lower number of transactions, it means you hedged it better, right? If you flip it around to hedge funds, your performance would be measured in terms of returns. Okay, for the same amount of risk, you could have invested into different kind of asset classes. You chose to invest into something. What was your alpha that you generated? Right? So if you have taken high risk, you would be maybe measured against small cap stocks. Okay, and against that benchmark, have you been able to generate an alpha out of it? If you have been able to generate alpha, well and good, right? If not, then your performance is bad. Whereas the other way around, it's a different objective. So I just take a short pause, right? And maybe someone can, if they have any questions, then ask the questions, comments, thoughts. Okay. You people also must be from one of the backgrounds, right? Maybe banks, hedge funds, or some financial institutions. So maybe you can share your experiences, thoughts, or have you seen such things, and how did you, make sense of it?
So you said that for investment banks, the expected returns are zero, right?
Yeah,
Uh,
you can say that. Like I
that,
said, there are exceptions to everything. Even the
right.
Walker rule itself has an exception, but the larger business model is that. Yes.
Mhm. Yeah. So I mean, again, still they are making money. I mean, right? They have to be net profitable. That's why they are in business.
Yes. So no, making money in sense of the commissions. Okay.
Okay.
You'll
Okay.
consistently keep money making there. If your
Uh-huh.
model is good enough, okay, it should be good enough. If it is too good enough, you'll lose in transaction cost. If it is less good enough, okay, then it will keep swaying. Okay, so you'll not be adhering to Walker rule. You'll be up to audits and all of that, and you have to explain as to why you could not hedge it well. Okay, in that sense, you have to be up for it.
Yeah. I mean,
the
that.
moment the moment you're locked into a trade, right, you have made money out of your fees and commission. Okay, over the
Uh,
rest of the life of the trade, all you have to ensure is it stays hedged without losing it. Okay, so right at the start, let us say you made commission of on a $1 million trade, you made commission of 100,000. Okay, now too many transactions will keep reducing this 100,000 kitty, right?
because of the transaction cost.
Yeah, it will keep reducing it to, from 100,000 you'll come to 80,000, 40,000, 50,000, something like that. And if you don't do it, then it can go either way, right? Then sometimes you might even lose a lot, and then you have to explain why did you not hedge it.
Yeah, and it also violates the Walker rule.
Of course, that opens up a Pandora's box. Apart from your bank, you have to explain to regulators what's happening, or it also shows you don't have control, right? Either you don't have control over your model, you don't have control over your operations, you don't know how to run your shop.
Right. And what about these market making firms? They also play on the bid ask spread, right? But I think they
Exactly.
are not bound by the Walker rule, so maybe they can sway
No,
on one direction or something.
no. So the major difference between market making and broker dealers. So these are called as broker dealers. Okay. The difference between market making and broker dealers is the fact that market making has securities to deliver. Okay. So if you want to buy a bond, apart from exchange, you can go to a market maker. Okay. And he will also quote it. For example, in I'll give you a simple Indian analogy. Okay. If you want to buy stamps, okay, you can go to maybe courts, okay, and buy the revenue stamps or whatever, right? Or you also have local vendors where you can go and buy. So you will call the local vendor as the market maker. Okay. So what he'll do is he'll go to courts, the market maker, buy the stamps in bulk and keep it ready, that in case someone asks for it, he'll sell it and make money out of it. Unlike that, investment banks don't already take opposite positions on. So for example, in anticipation that someone will come asking me for a detail option, they'll not pre-sell a bull call spread already on the exchange. Okay.
Yeah.
Only after someone comes up and asks for a product, they will say yes, we can offer this product to you, onboard that product, and then by the end of the day they try to hedge it out somewhere, maybe on exchange or maybe internally on OTC or somewhere else. So that is a primary difference between, let us say, a market maker and a broker dealer.
Okay. And market making firm will use its expertise to predict that in which direction the future
You
demand might
you
come.
can choose. You can
There might
choose.
be
Yeah, you can choose to
heavy on
take a
the
risk.
heavy.
Yeah,
Yes.
yeah. It's your security, right? You can choose to take a risk on that if you want. Okay.
Right.
Again, it is in their best interest to not take risk. Okay. For example, again, just take a simplistic example, right? Let us say you're a onion retail trader. Okay. All you do is, just like a market maker, you stock a pile of onions and you sell it. Okay. One way to make money is, buy it wholesale and sell it retail. Okay. So that is the commission. Okay. So that's the difference you'll make. The other way to make money is simply don't sell it, and wait for until the prices go out of hand. Simply stock it and keep it. Okay. And when the prices go up, sell it out. Also at the same time, you're exposing yourself to the risk that prices may go down further at that point in time. Okay. Then you have to be ready to bear that loss as well. So a market maker can choose to take positions on his own securities, right, and consequently make money out of it, or he doesn't want to get into risk of that and just keep selling the securities as much as he has as of now, right? So some of them focus on volume, that I sell. My target is to sell 20% more securities next year. Some just keep securities and have a view and wait for it, and then sell as and when they feel that the time is appropriate.
Right. But the same security is also available on the exchange, right?
Yes.
So
So
then why?
like I said, same revenue stamp is also available in the courts, right?
Right.
But you still buy it from the vendor. Okay. So what may happen is, okay, Tanmay, there is something called as short squeeze. Okay. I don't know if you're aware of it. For example, if you're short on call option, okay, and there are not enough securities to deliver. Okay. You are short on maybe 1 million bonds. Okay. But exchange has the capacity to only provide a certain of it. Okay. I don't mean that exchange does not have, it's just that at that point it does not have that liquidity, at that strike it does not have liquidity, something like that. Okay.
Right.
So then what happens, then you have to go to, because it depends on what is the kind of delivery, right? If it's a physical delivery, then you have to deliver that security, there's no choice. Okay. You can't give money in lieu of that security. Okay. If as per contract specification of that derivative, at the expiry you're supposed to deliver that security, then you have to deliver security. You cannot give money in lieu of that. Okay. So you separately have to go to an auction market buy it at whatever rate it is available to you, and then deliver it so that you honor your obligation.
Oh
Okay.
yeah, but how frequently does these things happen? I mean,
No, no,
this
no.
very
So
rare
no,
event,
point B, this is where market maker comes in. Okay.
right?
So he has residual or spare securities with him. Okay.
Right,
And then some, for whatever reason it's not available on exchange, then you go to market maker, you take it from him, and then you do it. Okay. Now, how frequently it happen? Again, I'm not a participant of it. Okay. So for
right.
example, okay, market maker who is selling bonds and all of these. Okay. As you understand, a retail bank, okay, at the end of each day, okay, it receives deposits and it gives out, let us say, loans or whatever, right?
Right.
So at the end of the day, it might end up with surplus cash, or it might end up with a deficit. Okay.
Correct.
So again, depending on what was the extra deposit and all, it needs to adhere to SLR, okay, statutory liquidity ratio. That X% of that has to be bought in government securities. Now, at that point in time, for whatever reason, there was sufficient liquidity with all the banks, right? Everybody had money, okay, and to adhere to statutory norms, they had to buy the treasuries, but they don't have treasuries available in the market, okay, because everybody has money, all the banks have, for whatever reason. Okay. For example, this 2000 rupee note, okay,
Mm,
which
mm,
was kind of, RBI said that maybe no, it may no longer be usable, right? So people started rushing back. So every bank has liquidity, right? They have money, but they don't have the proportionate amount of securities. Okay. So you need securities, but you can't go to another bank because another bank also is flushed with cash, but not securities. Then you would choose to go in to another, some market maker, okay,
mm.
and then get securities from him and adhere or be compliant with your compliance.
Okay.
Yeah. So you could be a market maker for a variety of reasons, but generally market makers will have the underlyings with them. They'll not have options and all of that, right?
Okay.
So they'll have treasuries, they'll have bonds, and to an extent they might even have stocks,
Okay.
but not really structured products or options or something like that. So that is again a major difference between a market maker and a broker dealer.
Mm, right.
Yeah. So I think whatever is the residual time left, right? I think it may not be sufficient to start a new topic, and it might take some time and discussion. I don't want to start halfway and keep it halfway. So either if any one of you has something to share, we can discuss over that. Or if not, then maybe we can conclude this call.
Ajit, I have a question.
Yeah, go ahead, Sam.
So, as someone who's extremely new to this field,
Okay.
yeah, what resources would you recommend that I can quickly brush up on this in depth?
So, what I would suggest, Sarthak, is right.
Yeah,
More than resources, okay. What matters is your understanding of anything. Okay. For example, you can pick something as simple as, maybe I'll just give you one word to start with. Okay, which is, let us say, derivatives. Okay. Now, right in front of you, I'm googling. Okay. So, derivatives. Okay. So it is a contract, and so on and so forth. Okay. And derivative can be traded on exchange or over the counter. Okay. Just pick one word, okay, out of it, and make sure that you fully build an understanding of it end to end. Okay. In terms of resource, you can choose any resource. You can choose Google, you can choose YouTube, Chat GPT, any textbook or everything. Okay. Popularly, the book which is followed is John C. Hull for derivatives. Okay. It
okay.
will give you a good background for mathematical understanding. It's very structured and all. Okay. But uh, more than about whether or not you read it, okay, and whether or not you retain it, you should be more interested in whether or not you absorb it. Okay.
Yeah,
what
makes sense.
Whatever example is given in the book, try to make it up yourself, okay, in completely different context, and only when you would have understood it you'd be able to apply it. So go to one that extra mile to apply it, and that's when you
Hmm.
will understand whether or not you have understood it. And you can, given that, again, like I said, you have Chat GPT, you can cross check your understanding. Okay. So you can check, if I apply something in certain context, okay, is it similar to this? Okay, does it make sense? Is it correct? Okay, Is this how things work?
Yeah.
What is your background,
Makes
Sarthak?
So I just finished up my BTech last year. After that, I worked in climate, making early warning systems.
Okay,
That's where I got into finance. Basically, a lot of like extreme value statistics and everything. All the examples were in finance.
okay, and
After that, getting interested, I got into a PE firm, which was basically for startup fundraising and that sort of things,
okay,
and an angel fund. So I have experience in basically more towards macro microeconomics.
okay,
And now, because I'm also a huge fan of programming, I wanted to get into like mix all of these up together.
right. So
Yeah.
I think
So
that is a very nice line of thinking. Okay,
yeah.
if you would think about derivatives, I would call that as a combination of lot of maths and stats and probability. Okay, a lot of product knowledge, and product not in computing sense but in the sense of financial products. Okay,
Yeah.
derivatives, structured products, like, and all the words which you heard here, right? Hundreds of such products. And third, very extensively coding.
Mm,
So yeah, it's a very nice blend of it. And nothing is kind of, you can just skim over it and it's okay. Okay,
mhm.
everything you would need to go to depth to understand it as deep as possible. And only when you have a reasonable depth of understanding of all three, that's when you'd be able to even execute one single simple easy thing.
Understood.
Yeah.
Yeah, that
so
makes sense.
so in your initial phases, focus a lot more on learning. Okay, and getting the hang of things. Like
Yeah.
what happens is, a lot of people get frustrated. Okay, I have spent so many hours but I'm still not able to make anything out of it. I'm not able to apply it. I'm not able to use it. Okay, have patience. Only when you understand everything in depth reasonably enough, only then you'd be able to uh, most significantly apply it. Okay, so this requires a little more patience.
Yeah, makes sense.
Yeah.
Uh,
Anything
Thanks a
else?
lot.
Hello,
Yeah,
Ajit.
that was a great answer. Thanks a lot.
Right, right, happy to help, Sarthak. Go ahead, Rahul.
Uh, yes, actually, I joined just now. I was somewhere.
No, no
Um,
worries, Rahul. I have been recording this session. I'll put it up on our, uh, WhatsApp. I have yet not thought about how to do it, but I'll put it up there. Okay, you can go through it again, and hopefully it
okay,
helps you.
okay. Thank you. Just one question I just want to.
Yeah.
Uh, Actually, I'm working as a data scientist
Okay.
for last 4 years.
Okay.
So I'm just new in this finance world.
Okay.
So can you just guide me from where I have to start or something like
So finance, okay, you can split it up into two parts. Okay,
that?
one largely the investment part of it. Okay, where you put in money,
Okay,
like as simple as buy buy low and sell high, as simple as that. Okay, that is investment
okay,
side of it, making money out of it. Second is risk management side of it. Okay, so the field of
okay,
quantitative finance, financial engineering, and all of these focus largely on the risk side of it. Okay, and not much really on the finance side of it. Although it doesn't mean
okay,
that these are not money making businesses. Okay, they also make a chunk of money. Okay, but just a different way of doing the same thing. Okay, so first you decide whether you would want to pursue the direction of pure finance. Okay, which has mergers and acquisitions, a pure play investment bank. Okay, discounted cash flow valuations, how to value two firms, how to help one firm buy another firm. Okay, look at their fundamentals, balance sheets, cash flow statements, and all of that. Okay, that's a completely different field. Okay, as intensive
okay,
but different. Quant finance is
okay,
altogether different. You have derivatives, you have options and futures and all of this, right? Then you have risk management, various risk management tools, statistical tools and methods. Okay, but
okay.
just a caveat: if you go to investment side, you will find much higher application of machine learning. But if you go to risk management
Okay,
side, those are very heavily analytical models in nature and much less data mining or machine learning and all of that stuff. Okay, so if you want to further strengthen your portfolio in the same direction which you are going, been going for last 4 years of data science, okay, and apply it on stocks and make money out of it, that's a different line.
Mm.
Okay, so that is
Okay.
investing. Okay,
Okay.
quant
That is
finance,
invest.
yes, that is investing. Okay, but quant finance is altogether different. Quant finance is, let us say, you're interested in a lot of equations and maths, and solving partial differential equations, stochastic differential equations, probability,
Okay.
and you
Mhm.
are good at coding. Okay, so that you are able to build products quickly and execute all these things, okay, whatever you have learned, fast and quick,
Mhm.
then
Okay.
that is the way to go, and not this. Okay, but this is the starting point, so you need to make a choice. Whatever choice you make, the returns depend upon how much time and effort you invest. But I will suggest against trying both things simultaneously, because that would mean you would most likely not be able to be a more perfectionist in either of it. Okay, so it will simply drain you out, and it will feel very
Mhm.
daunting for you.
Okay.
So just in terms of certifications, Rahul, CFA and all
Mhm.
of these certifications go in the direction of investing. Okay, FRM,
Okay.
CQF, these kind of certifications go in the direction of quantitative finance.
Okay. If I choose the quantitative finance, then my data science means experience will help me to this.
Yes, because like I said, even in quant finance, you need to learn. So whatever initial investment you would have done in learning basic stats and probability and all of that, that stays. You need not redo it. Okay, so you have the base.
Okay.
All you have to do is you have to build on that. Okay, whatever different things are required, you need to just grasp them up and use it.
Okay. Got it. Thank you.
Yeah, happy to help, Rahul.
Thank you.
Anybody else? Any closing comments? Anybody's thoughts? Maybe you could share your experience. Where do you work? You know, because we are in larger groups, someone might be able to help, and provide certain inputs. Okay, I think we are then towards the end of our call. Even if not here, maybe we can continue our discussion on our WhatsApp group. We can have ask questions, and of course there are not many people there, so would be you might have a lot more varied views and answers, and eventually might shape up what final outcome we are looking for. So nice talking to everyone, and let's see how it goes from here.
Yeah, thanks a lot. Thanks a lot.
Thanks a
Okay.
lot, Ajay.
Yeah. Nice,
Thank
nice talking to
thank
you.
you.
Yeah. Thanks. Bye. Closing the call.